Now, I said something kind of special there, and I don't know if you caught it. I said with less downside risk. Because when you buy that call or any option, you can only lose what you pay for that call. There's basically a built-in put embedded in this trade. The call, it's likely to have some time value. We typically don't go so far in the money that there's no time value for various reasons, and I think we're going to talk about that throughout the show. And because there's some time value, that's effectively what you'd be paying for this, air quotes, put.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 63, Poor Man's Covered Calls. But before we begin today, I have an announcement. As you know, the idea of this podcast has centered around the book that I've been writing and, well, now I can say have written, Build Consistent Wealth with Options. Well, I have some very exciting news. On April 28th, just 1 week from today, for those of you who are listening live, Build Consistent Wealth with Options will be available for purchase. Yay! I cannot tell you how excited I am about it. I spent years developing the strategy that I discuss in the book. I spent many nights and weekends writing and rewriting and creating what I think is the absolute best work ever written on the wheel strategy. I'm really proud of the end result, and I think you're going to find it just as great as I do. A lot of times with trading education books, when the author really has a great strategy, well, they keep it secret. They don't put it in the book. And that kind of makes sense. They don't want the rest of the world trading their trade and squeezing all the edge out of it. But that's not what I did. For one, with covered calls and cash secured puts, because they require the margin similar to taking a position in the underlying shares, not as many options are traded as other types of strategies. So there's less risk of the trade becoming crowded. There's not so many options being traded. But also, I've been doing this a long time, and I'm in the give back phase of my career. So I did not hold anything back. Lessons I've learned from a lifetime of option trading are all packed into this book. So I hope you will buy Build Consistent Wealth with Options, and I hope this book will change your life as much as I think it can. Because you're one of our valued listeners, and so many of you have been on this journey with me since the show launched over a year ago now, I want you to not only get the book, but also get some special free bonuses that go along with it. So you have two ways to go about continuing your journey with the book, Build Consistent Wealth with Options. First, you can go to bcwwo.com. That's B as in beta, C as in kappa, wwo.com. That's the initials of the title of the book, Build Consistent Wealth with Options. And get on the list there, and you'll get updates on the release schedule, pre-launch bonuses, excerpts from the book, and more. And then we'll remind you on the day the book is available so you can go and grab it online. Or the other way you can continue this journey is to become an all-in wealth builder. Our paid subscribers who join as an all-in wealth builder, which is an annual subscription that comes with massive bonuses, including video extra podcasts, our monthly Ask Me Anything webinar, unusual options alerts, the ability to post comments in the show's Substack community, plus our live Friday morning group coaching class online, where we share trade ideas real time, and our MTM Smart Income System video class, which is all on the wheel. And that class alone is worth more than the subscription investment that you would make becoming an all-in wealth builder. Plus, here's the best part. For the all-in wealth builders, I will personally send you an autographed copy of the new book, Wealth Building with Options, and that is all covered in your subscription fee. To get that really massive value, go to wealthbuildingpodcast.com. That's wealthbuildingpodcast.com and choose the all-in wealth builder subscription level. Once we see your subscription, we'll email you to get a physical address for me to send the book to. One of the things about trading the wheel is that with covered calls, you have capital invested in the stock. And with cash secured puts, you have capital set aside as margin to buy the stock in the event the put gets assigned. Either way, wheel trades tie up much more capital than other option strategies. And so some traders who don't have large enough accounts, well, they're simply not able to trade them. This is when investors might choose to trade a covered call another way. It's possible to create a very similar position to a covered call using only options and using significantly less capital. I'm sure by the title of this episode, by now, you know what I'm talking about. I'm talking about what is affectionately known as the poor man's covered call. So friends, let's dive in today to this episode. The poor man's covered call is a name for a specific type of diagonal call spread where a trader buys a longer term in the money call, which is done as a cheaper proxy for owning the stock. And then the investor also sells a shorter term out of the money call. This strategy kind of blurs the lines between investing and trading somewhat. The term diagonal call spread indicates that it's a combination between a vertical spread and a horizontal spread. These are two very common options strategies. A vertical call spread is when a trader buys one call and sells another call in the same expiration, but with a different strike price. A horizontal call spread is when a trader buys one call and sells another call with the same strike price, but with a different expiration. With both those spreads, the optimal price for the stock to be at expiration is at the short options strike price. Sound familiar? Kind of like a trade we've talked about, isn't it? A diagonal call spread is when a trader buys one call and sells another call in a different expiration with a different strike price. Now, that's really the only rule when it comes to a diagonal call spread. Both calls, buying one, selling the other, different expiration, and different strike price between the options. Now, the most common way to trade this is buying the longer term call at a strike price below where the stock is, so it's in the money. And we do that to give it a bigger delta so that it acts more like the stock, and a lower theta and a lower gamma and a lower vega, which is done to get rid of all the other what we call optionality, time decay, gamma, the effect of implied volatility, and just try and get a bigger delta. In effect, what we're really doing is buying that call as a close enough proxy for buying the stock. And because it's a call, it's much less expensive than buying the stock. It's much more cost effective and better for smaller accounts. The shorter term call in a typical diagonal is sold at a higher strike price than where the stock is, so it's out of the money, and that gives the stock a little bit of room to run so that the long call can make money on delta without the short call becoming in the money. So you see, this is very, very much like a covered call, but, just a little different. A benefit of this trade is that the proxy for the stock, the long call, like I said, costs so much less than buying the stock. And so that's where we get the name poor man's covered call. It's the kind of the poor man's version of buying the stock. And look, that's just what they call it. I didn't make up the name poor man's covered call. It's kind of a silly name, really, because lots of people, present company included, will use this time to time, not necessarily because they're poor or because you don't have the cash, but because maybe you want more protection, less risk to the downside. Maybe you just want to use that cash for something different. Maybe it's just easier that way. There could be lots of reasons, but hey, we call this specific call diagonal where we're buying it in the money longer term, selling it out of the money shorter term. We call that special diagonal the poor man's covered call. Now, I said something kind of special there, and I don't know if you caught it. I said with less downside risk. Because when you buy that call or any option, you can only lose what you pay for that call. There's basically a built-in put embedded in this trade. The call, it's likely to have some time value. We typically don't go so far in the money that there's no time value for various reasons, and I think we're going to talk about that throughout the show. And because there's some time value, that's effectively what you'd be paying for this, air quotes, put. We can consider the long call from the synthetic perspective, right? A long call is synthetically equivalent to long stock plus long put, right? But there are some key differences. There is, of course, less risk with less capital invested or with the built-in put, depending on how you want to look at it. But in that same regard, in a way, there's more risk. The synthetic is paid for with the premium over parity, the time value of the long call. That time value decays over time, and that creates a little bit of a drag on the otherwise better covered call, air quotes around better covered call too. Assignment, that's different too. The risk of the short call in the diagonal is not covered. It's a spread. So it's not really a covered call at all. When risk is spread, it means some of the risk of one option is offset by the other option. And that holds true unless and until the option is assigned. If the short call is assigned, there's no underlying stock to be called away. Instead, the position becomes long call with short stock instead of a short call. The key to understanding how and why to trade call diagonals is in the setup criteria, the Greeks, and also in the trade management. Let's start with the trade setup criteria. We set up a poor man's covered call, typically like an out-of-the-money covered call. It's designed to profit from a stock that rises to, but not through, the short call's strike price, as well as to make money as time passes. So, all the criteria for setting up a regular covered call are very similar for setting up the poor man's covered call version. One of the times poor man's covered calls can work well is after the stock falls like a lot. Why? Because when a stock falls a lot, that typically leads to the shorter term options implied volatility getting really, really high. And the longer term option, well, their implied volatility might rise a little bit, but it doesn't rise as much as the short term one. So this solves a very common problem with call diagonals, which is vertical skew. We talked about this on a show, oh boy, a long time ago. I'm reading some of the notes from the manuscript of the book here, and it says that I talked about it in chapter 6. We're into chapter 16 at this point of the podcast. But vertical skew is the observation that options on the same underlying and in the same expiration have different implied volatilities among the different strike prices. Typically, stock options see implied volatility increasing with each successively lower strike price and then decreasing with each higher strike price. Well, that's usually not ideal when the option being sold is at a higher strike price because it has a lower implied volatility. And the one being bought is at the lower strike price with the higher implied volatility. Buy high, sell low. Wait a minute, that's not how this is supposed to work, is it? Now, it's not always a deal breaker. Hey, otherwise nobody would ever buy a bull call spread. But this negative skew that I'm talking about, it means that we end up sacrificing one of our sources of edge when we trade this kind of trade, when we buy the higher volatility and sell the lower volatility. As long as the trade is strong enough in all the other criteria, that can be acceptable, giving up that one edge source. But when the stock falls and the short-term calls implied volatility gets pumped up, well, that can create a beneficial trade where we're not giving up that edge source. As far as the Greeks are concerned, delta, theta, and vega are always important to constructing and managing any option trade, including the poor man's covered call. Let's imagine an example where a stock has fallen and a trader believes that it's been oversold. This might be based on technical analysis because maybe it hit support and bounced higher and has crossed back above the 30 line in the RSI indicator. Or it could be from a fundamental perspective and the price is a lot lower below its intrinsic value, or its price to book or PE ratios are really low, maybe even factoring in possible lower future earnings expectations that might have caused the stock to decline in price. Let's imagine a stock that fits this criteria trading at $42.15. Let's say we think that the stock is going to steadily grind higher over the next several months, make back some of its losses. In this case, we might trade the following diagonal. We might buy, say, 10 of the longer term, say the 214-day to expiration 30 strike calls, so like $12.15 in the money, at $13.10. And then we might sell a shorter term, like a 25-day option, 10 of those, at the 45 strike price and collect, say, 65 cents. So let's look at the Greeks of this 10-lot trade. Again, this is buying 10 of the 214-day 30 strike calls and selling 10 of the 25-day 45 strike calls. So I created a little table here, and I'm actually grabbing this example out of the book itself. The delta of the longer term calls for the 10 lot is going to be long 860 deltas, and the delta of the short term 25-day calls is going to be short 270 deltas. So 860 minus 270. The diagonals delta is long 590 deltas, which is the equivalent to being long 590 shares. The theta, we're going to lose $10 a day on the longer term in the money calls, and we're going to make $27 a day on the shorter term out of the money calls. So we lose 10, make 27. We're making a net of $17 a day on the spread for the 10 lot. And notice that theta differential, that's really the whole magic of this trade. The longer term options tend to have smaller thetas. In the money options have smaller thetas. Shorter term options have bigger thetas, and those are the ones we're short, and we're not as far out of the money relative to how far in the money we are with the long one. Now let's look at Vega. The Vega for the long-term calls on the 10 lot is $68, and the Vega for the short-term calls is $38. That's net being long 30 Vegas. With spreads, delta and theta are the most relevant when looked at as a single unit, like looking at it as the spreads delta or the spreads theta. And we just talked about how theta is kind of the real magic here. There's still a little bit of magic when it comes to the delta. Buying the lower strike call with a bigger delta and selling a higher strike call with a smaller delta gives a net positive delta, and a pretty strong net positive delta. The long strike really controls the delta. That's what we want to focus on for the long strike. Farther in the money gives a bigger spread delta. Closer to the money gives a smaller spread delta. Selling the shorter term and buying the longer term call should be constructed to supply a positive net theta. And typically, it's just going to kind of end up that way. But if you're buying too close to the money and selling too far from the money, you could end up with negative theta, as in paying money every day to carry this position. So you want to be very, very diligent in your strike selection. The short strike is selected resulting from a balance of three things: premium you collect, the theta you collect, and the room to run, how far away from the current stock price that short call is. The premium earned on the short call must be big enough to be worth selling. But we want to make sure we have enough room for the stock to run higher without the short call becoming in the money. I don't use annualized return when it comes to diagonals like I do with regular covered calls. Instead, I think more in terms of selling above some minimum threshold. We don't want to sell the short call for pennies. And I also think of it as a percentage of the long call's premium that's big enough to make rolling practical. And more on that a little later. So like I said, we really have to make sure that we're selecting strikes where it does yield a positive theta. We got to look at the Greeks on this. Because again, a positive theta is really a very, very key ingredient to it mimicking a covered call. Also consider this is always going to be a skate objective trade. We're never going to want to get assigned on a poor man's covered call. So the short strike should be set at a strike that the stock is unlikely to rise through by the option's expiration. Resistance is a very important tool to use here. Now, where delta and theta, it's important to look at the differential, the spread delta and the spread theta. Vega's a little different. Poor man's covered calls, they're made up of options that not only have different strike prices, but they also have different expirations too. That means changes in the vertical skew or the term structure, both can cause the volatilities of options to move independently of one another. So the net Vega, the spread Vega, it's less useful here than it would be with the spread delta or the spread theta. When part of the setup is the assumption that the short-term implied volatility is higher relative to its normal level because the stock fell, right? Well, then we expect that front volatility to come back down when the stock begins rising again. We call this reversion to the mean. So it's best to consider the implied volatility of each individual option and not as a spread. Now, I said we also have to talk about managing and rolling here. Typically, the plan for a poor man's covered call is to roll, collecting more premium each week or month or whatever the rolling period is, each time reducing the net capital expense for the overall trade. What I mean by that, I mean subtracting the option premiums collected from selling the cyclical series of short options from the one-time expense of the long option. In this example, let's assume I'm using a stock that has weekly options. So there's a whole bunch of flexibility for rolling. If this trade were to play out just perfectly, the stock would rise while I have the trade on to be close to, but not through, the 45 strike call that I'm short, right around expiration. And if that case plays out, then the tactic is to roll up and out. The goals are to buy that original short-term 45 strike call back for pennies and sell the next strike at a higher price, maybe 46 or 47 or whatever, giving the stock more room to run still higher for another week or 2 weeks or whatever it is. Then roll up and out at the next expiration and continue on and over again. So let's look at what I might mean by this. So at the expiration of the original short-term 45 strike call that we sold at, what did I say, 65 cents. Let's say we can buy them back at 3 cents on expiration day, and we get a profit of 62 cents then, right? 65 minus 3, we made 62 cents. Then we sell to open, probably as part of the same trade, the 47 strike calls that have 2 weeks until expiration now. And we sell those at, say, 69 cents. Then when that expiration comes around, ideally the stock has risen close to, but not through the strike price, and we buy them shortly before the bell on expiration day. We buy those back for 3 cents and then sell maybe the 48 strike calls 2 weeks out until expiration. Ideally, each time the trade would lock in profits from theta on the short call and profits from delta on the long call. Each time the strike is rolled higher, it creates more room to run. And when you sell that extra option 2 weeks out, we also collect more theta. And again, like I said before, this is maybe a little bit more of a trade than an investment compared with a traditional covered call. Generally, with trading, when a position loses, traders close it to take a small loss before it becomes a big one. So if the stock falls too much, we'd want to exit the entire trade and just take a small loss. Now, that's very, very different than how we would manage a regular covered call. But there still are some commonalities to managing a covered call. If there's just a small decline in the stock price, well, that would lead to easily buying back the short option, the short call for a profit, and selling one farther out in time, maybe at the same strike price, or hey, maybe even at a lower strike price. Doesn't necessarily much matter, as long as you're whittling away at the net capital you spent on the long call over time. The most important thing to know about managing poor man's covered calls is that because the call is not covered, we want to avoid assignment. Now, of course, it's not always possible to avoid assignment. You might have an overnight gap where the stock just rips through the short call strike price overnight. But as a rule, when the short call becomes in the money, it is time to take an action, probably to roll. Taking a loss on the short call can be thought of as just a cog in the wheel to be made up for in future call sales, just like we think about it with the covered call. Though because this is also a trade, if the stock blows through the strike price more than one time, well, then That's when we acknowledge, hey, I think maybe I was wrong on this. It's not going to steadily grind higher. It's just ripping higher and higher every time I sell a new call. So I'm just going to close out of the trade entirely, take a loss, and move on to the next trade. And that about wraps it up for this show. But before you go, don't forget to get a copy of my new book and some really great bonuses. Either go to bcwwo.com and get the bonuses, and we'll let you know when you can order Build Consistent Wealth with Options online, or go to wealthbuildingpodcast.com, become an all-in wealth builder, and your paid subscription gets you lots more great bonuses, as well as an autographed copy of the book sent to your home. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.